All right, so today is Monday, October 23rd. This is the 11 a.m. section. Apparently, there was a water main break on campus today. These students have volunteered to bravely stay in our classroom for fear of not drowning. And I know the classes later today are going to be canceled, so we're recording this one just in case. All right, so what our goal is this week is to basically take the NVIDIA valuation model we started to build 2 weeks ago and finish it off, okay? And your next homework assignment due 1 week from today will be to take this model and use it to value another company, okay? So I am not handing this model out, so it's very important that you complete the model that we are building here in class today because you're going to have to use that model to value the next company, okay? Yes, sir?
You have homework 9 due in 2 weeks.
It's going to be due next Monday. I'll be changing that. Okay. So, and my goal is to actually make the campus water main break has screwed this up, but we're going to still try this, to make Wednesday a Bloomberg Lab day so that you can get the data to do the actual valuation of company number 2 and then have Thursday, Friday with the TAs for help. Okay. That's why it's kind of important to kind of continue with the class today. All right. So we need to finish this valuation model. We've got about an hour to get it done. So picking up where we left off, just as a reminder, what we had done is using raw data that was exported from Bloomberg, we created standardized income statements and balance sheets. We then used ratios to forecast these income statements and balance sheets for the next 6 years, which then created the TFI, TII, and CFIs, including the forecast for the next 6 years. And basically, the important part is that in CFI, we have forecasted cash flows. Okay? So what we're going to do is we're going to take those forecasted cash flows and turn them into an enterprise DCF. And so I'm going to just save this as the NVIDIA valuation. And I would recommend you save frequently because you're going to be turning in this model. All right, so we're going to create a new worksheet. I'm going to put it at the end of the model, and we're going to call this worksheet the DCF valuation tab. Make it a little bit larger. All right, so following Modigliani-Miller, right, we're going to first value the operating value of a company, starting with Nvidia, which is based on free cash flows. Okay, that's one of the reasons why we did the reconverted CFI, because free cash flow is the cash flow available from an operating perspective. So that's going to be the operating value of the firm. Okay, so what we're going to do is starting in cell B1, again, a little bit bigger, free cash flow. And our first forecast year, because we're forecasting the free cash flows, in cell A2, it's going to go from the CFI tab, H2, 2024 for NVIDIA. Okay, I want to use relative references, and then equals that plus 1 for the following year, 25, and going down the rows, we're going to go to 5 years out, 2028. Okay, so these are the free cash flows for the next 5 years that we're forecasting, assuming our ratios come true. Okay, now again, we'll put in more realistic ratios in a little while, but this is just how we're starting to build it. Okay. Now, the reason I didn't do year 6 is because year 6 is the beginning of what's called the continuing value period, right? So best practice, as per the book, when you forecast, you always forecast an N+1 or a T+1 year, okay? And that final year is the beginning of your continuing value period, all right? So we have forecasted 6 years because the first 5 years we're going to forecast year by year. Year 6 into perpetuity is continuing value. Okay, so that will be, in this case, 2029. That's why I'm only going to 2028. And now I just want to transpose the free cash flows that we have forecasted into these corresponding rows. So for 2024 free cash flow for cell B2 equals from the CFI. 2024 free cash flow is right here, row 14. So H14 off of the CFI. 2025 free cash flow equals off of the CFI I14. 14. 2026 is CFI J14. 2027 forecasted free cash flows off the CFI is K14. And 2028 free cash flow off the CFI is L as in Larry, 14. So I'm going to format these, same as we did the other numbers, to one decimal place. Okay, so those are the 5 forecasted free cash flows, assuming those ratios come true. Right? Now, it's very important that since we're doing a DCF, we have to discount these cash flows to a present value. Okay? So I need to put those into today's dollars. So I'm old school, and a long time ago I learned the concept of using a discount factor. To get to the present value of the free cash flow. But the way the discount factor worked is you take 1 divided by 1 plus r to the n. So equals 1 divided by left paren 1 plus, and the r is the WACC, which is on the assumptions tab. So that is B4 off the assumptions. Yeah, I'll just put that to 4 decimal places so it's easier to see. So the idea is if you take your free cash flow, you multiply by the discount factor, then you get your present value. So equals B2 times C2. Now, if you want to shortcut this and use the present value formula directly, you can. All right, I'm just, like I said, old school, like to see how things work. But nonetheless, that's the present value, 4048.2 of that 4400.4 in today's dollars. All right, now I'm about to copy this down, and I always wanted to refer to cell B4. So I'm going to put a $sign in front of the B and a $sign in front of the 4. Make an absolute reference to the WACC, and I'm going to copy that discount factor down to 2028, except starting in 2025, it's 1 plus r squared. So 1 divided by 1 plus r squared. So put at the end of that, shift 6, 2 for squared. In the third year, we divide by 1 plus r cubed. So at the end, shift 6, 3. 2027, fourth to the power of 4, shift 6, 4. And 2028, shift 6, 5. And so basically just copy this formula for D2 all the way down to D6. And so those would be the 5 years of present value of the free cash flows, assuming that WACC. Okay? Go with me so far? Let me sum them up. Okay? So this is now the operating value first 5 years. All right? And it's basically going to be the sum from D2 to D6. So, assuming these numbers come true for Nvidia, they will generate $17.3 billion worth of operating free cash flow value in the next 5 years. Okay? All right? Now, Nvidia doesn't just end at the end of year 5. Okay? The assumption we make for companies is that they live forever. Right? Whether or not that's true, we're not going to be around to find out, but that's the assumption we make. That's why we use perpetuities. So the idea is we need to do a continuing value for Nvidia, long-term value, right? And the key here is we are going to use the key value driver equation, the rearranged KVD from McKinsey, which is the rearranged growing perpetuity, to estimate continuing value. Right? So if you remember that in our lecture notes, starting even in lecture 1, we used, this is the key value driver formula right here that we derived from the, okay? And did some exercises on that, but just to remind ourselves of this formula, this was the formula for perpetuity, and in Excel, I am going to put this formula smaller so it fits. There we go. Into cell B10. Okay, so that's basically going to be the long-term value of Nvidia. So I need 4 parts of that formula. I need an expected profit, which is the NOPLAT, right? I need a G, I need an ROIC into perpetuity, and I need a WACC, okay? These are going to be assumptions because they could change, okay? So what I'm going to do is in the assumptions tab, we already have a WACC. So right under that, I'm going to put in the next 3 assumptions. Continuing value, NOPAT, that's my profit. Continuing value, ROIC, and my continuing value, G. Okay, so those are now WACC, NOPAT, ROIC, G, the 4 things that are going to go into that formula. And since those are assumptions that could change, I'm going to make them yellow, company by company. All right, now as a starting point for my continuing value NOPLAT, or NOPAT, which is cell B5 in the assumptions, equals from the TII, we have column M, which is the first of our continuing value periods. We have a forecasted NOPAT for that. So the starting NOPAT there is M5 off of TII. The continuing value ROIC we will need one as a starting point. And if we go to our ROIC, we don't have one. All right, so here's what I'm going to do. For our ROIC off of the assumptions equals for B6, TII NOPAT, M5 divided by TFI invested capital, which is TFI M8. That is our ROIC in year 6 right now. And we'll use that as the beginning of our continuing value NOPLAT. Just again format these to 1 decimal place. Make it a little bit cleaner. All right. And for continuing value G, we're going to start at 3%. And the reason we're going to start at 3% is we make assumptions that companies generally grow at a mature rate with about the economy. And the U.S. economy tends to grow 2 to 3% in the long term, so we're going to put 3% as a placeholder. We will change that assumption. I'm just leaving it there as a placeholder for right now. Okay? So these are our placeholders. 3% for a G. Make that 2 decimal places. 1 decimal place. Continuing value ROIC, which is the final year NOPAT divided by the final year invested capital. And we have the continuing value NOPAT, which is the final year off the TII NOPAT. Those are the 4 assumptions, and we got my WACC. So I'm going to take those formulas, those 4 numbers, I'm using this formula, put it into cell B10 of our valuation tab. It's the hardest thing you got to do today. Get this order of operations right. Okay, so this is the order of operations. Equals, left paren, building off the assumptions, profit, which is B5, times left paren, 1 minus the growth, which is B7, divided by the ROIC, which is B6, right paren, divided by left paren, the WACC, which is B4, minus the G, which is B7, right paren, enter, $69 billion, $69.9 billion worth of continuing value. And I'm sure you're going to be like, can I see that formula again? That's the formula. It's just putting that formula built off the assumptions that we just put in with the right order of operations. Okay? So again, this is being recorded on video if you need to go back and check the formula, but this is the formula. And that should be the number that you get right now. Okay? But that's the point. That growing perpetuity, key value drivers, discounts it to the beginning of 2029. Okay? We need it in today's dollars. So we still have to discount it to today. And it's very important to remember that 2029 was already discounted in the growing perpetuity. So we don't want to double discount 2029. So basically January 1st, 2029 is basically the same as December 31st, 2028. So we basically use the same discount factor equals the 2028 discount factor, multiply B10 by C10, and we get a present value of the operating value into perpetuity, which again is about 46 billion. Okay, so that's the whole point. The total operating value we are forecasting for Nvidia equals the first 5 years, D8 plus D10, the perpetuity period. Add them together because they're in present value, we get 63.4 billion of operating value of Nvidia selling their chips. Yes?
Can you repeat how you got D10?
So D10 is just B10 times C10. Because we got to bring the value of B10 back to today. Because again, if we're going to add things up, it got to be in present value. And B10 is at the beginning of 2029. So that's why we're discounting it again. Yes? Question?
C10, did you just bring it down?
I just equaled C6. Use the same discount factor. Question in the back? Yes?
What was the, how did you find the operating value after you did the income value?
The operating value is just adding up D8 plus D10. Just add the two. First 5 years plus that continuing value. That's total operating value of Nvidia or whatever company you're going to value. Okay? Now, yes?
I don't know if what I'm saying is correct, but I thought it was taught before that you can get the same effect in your like when you're solving the terminal value, you can take the 2028 profit and then multiply it times 1 plus G, and then divide it over wax minus G.
Well, we're using the McKinsey version of the key value driver, which also allows us with the rearranged math to forecast ROIC. And the formula you're taught doesn't, which is the real problem, as I said, when we introduced KVD, is it assumes whatever your current IRR is, it goes into perpetuity. And that could be a problem because the future looks different than the past. You can't solve for that with that version of the formula. That's why we're using this version of the formula. Okay? Yes? All right, so just moving along, Modigliani Miller, operating value plus non-operating value equals enterprise value. We now have our operating value. We're now going to forecast the non-operating value. Here is where TFI helps you. Because for non-operating value, we've actually listed the non-operating items on TFI. A10, A11, A12. Okay? Now here's the other thing. We make an assumption that companies aren't good at non-operating things, right? I don't invest in Nvidia because they have a bunch of cash in the bank, okay? So we assume that in the future, non-operating items are generally NPV 0, right? We can always change that assumption, but generally they're NPV 0. So basically we value non-operating items at their current value today, and we say that they're not gonna really grow more than the cost of capital because the company isn't spending a lot of time on those, okay? Now again, that could change for certain companies if they were like passive investors, that company was skyrocketing in value. So for example, Microsoft investing in ChatGPT, which is now going to be worth like $40 billion. Like there's a non-operating asset that could be much more valuable. But that being said, for most companies, the non-operating values don't change. Okay, so we're going to use the current non-operating values as the value of the firm. Okay, so in this case, DCF value equals, starting at row 14, TFI, A10, A11, A12. And the values, starting over in D14, equals from TFI is G, which is the last reported year, 10. Let me just copy that down. So those are the three non-operating values. So I'll sum them up. Equals the sum of those three. So about 18 billion. One decimal place. So the total enterprise value that we are forecasting equals the operating value plus the non-operating value, which would be 81,461.3. To one decimal place. Okay? So again, if all of our assumptions come true, that's how much enterprise value we're forecasting for NVIDIA. Right? Now, NVIDIA does not have any long-term investments. And I just made a comment that somebody like a Microsoft could, and that long-term investment could be far worth more than its book value. Okay? Because accountants don't value investments on the balance sheet at market value. They put them on book value. Okay? So what we are going to do, if we do run into Microsoft or somebody like that, is back in our assumptions, we are going to take the multiple of value of long-term investments, which we're going to put at 1. And we're going to make that yellow. All right? And so here's what we're going to do. Just if we do run that circumstance and something on the balance sheet is worth far more as a market value than its book value, then we're going to take this long-term investments, TFI G12, and we're going to multiply that in D16 by assumptions B8. So for example, if I own something that was worth 10 times what I paid for it, in assumptions, I put a 10 in there, and it will just auto-multiply it to a more market value. Because remember, in this tab, we're dealing with market values. Okay? On the TFI tab, we're dealing with book values. So if something's worth more or less, I could also adjust it using that multiple. You're probably not going to have to do that for most of your valuations. NVIDIA doesn't have any long-term investments, but we're putting in there as a placeholder for a company that might. Yes? So take, for non-operating value, long-term investments, take that, multiply it by assumptions B8. And assumptions B8 is the multiple of the value of those long-term investments, if they're worth different market than book. And that's just a placeholder. Again, doesn't affect NVIDIA, but it could affect another company. All right. Finally, I'm trying to solve for equity value, okay? Which basically means to take enterprise value, pay off all my debt, that's next, pay off all my non-common shareholders, and what's left is the value to the common shareholders because they're the last to get paid. Again, this is where TFI helps us. Because when we rearranged our TFI, we listed who needs to get paid. And what we're paying them is what we owe them today. It's already in present value. So starting in A22, off our DCF, equals from the TFI, the first people we have to pay off, retirement. Second people we have to pay off the TFI, interest-bearing debt. Third people we have to pay off from the enterprise value off the TFI, because we're solving for common, is the preferred. Fourth people we have to pay off the TFI is the minority shareholders. Those are the 4 stakeholders that have to be paid off, and whatever's left belongs to the shareholders, the common shareholders, as a residual. They're the last to get paid. Okay? So what do we owe them today? Already in present value, starting with D22, equals TFI for retirement. That's G, it's the current reported numbers, G15. Interest-bearing debt equals from the TFI, G16. Preferred is from the TFI, G18. And minority shareholder stakes that have to be paid off, G19. So those are the 4 non-common shareholders that would have to be paid off. And format to one decimal place. And what would be left would be our common equity value. And the common equity value in D27 equals the enterprise value minus the sum of those 4 things. So that would be $69,430,000,000 for NVIDIA, based on these assumptions coming true. Okay? Now, if we're forecasting a share price, the next item we're going to need is we're going to need a shares outstanding. So if we divided by the shares outstanding, we would get a forecast share price. Okay. Now, shares outstanding is going to change company by company. Okay. Again, if we did Microsoft, they'll have a different share count than Nvidia. Okay. So I don't want to put that in as a hard-coded number. So on my, I'll copy this, on my assumptions, the next assumption down, A9, is my shares outstanding in yellow. So I'm going to put my share count here. Now this is where you're going to go to Bloomberg. Okay, we're going to use 3 screens on Bloomberg to get data for our valuations. One of them is DES. So we will go to Nvidia, and then we will go to DES. And we're going to take a screenshot of this. Okay. So this is going to be very important for your valuation model for 2 reasons. And I'll take the screenshot, NVDA, NVIDIA, DES. Whatever, close enough. All right, so we're going to get 2 things off the DES screenshot. One, there's the share price of Nvidia today. That's the one we're going to try and get close to. This is a concept known as an as-is valuation, meaning we're going to value the company based on its current price. That's the first step of our valuation model. Recreate the price in cash flow model. Point number 2, down here, current shares outstanding. All right, it's easy to get to. The current shares outstanding for Nvidia are 2,470,000,000, right there. So 2470. So basically, in Excel, 2470. Okay. Now here on my DCF valuation equals, from the assumptions, 2470. And my share price equals common equity value divided by shares outstanding. So if those assumptions came true, we would forecast a share price of 28.11. Clearly, Nvidia is worth a lot more than 28.11 because those assumptions are pretty conservative, right? But that's where we would be right now. Make sure you save this file. Everybody get to this point? Okay, so our goal, because you have now, most of the valuation model is done, okay? Because basically, we have cash flows that lead to a price. And as I said, our goal, our first valuation model, we'll always do 4, but this is number 1, is to create what's called an as-is model, which means Nvidia's price right now is about $425 a share. So we need our model to get to $425 a share, right? And the standard we use in this class is within $1, okay? So when I say value a company as is, you have to get our model to be within $1 of their currently publicly traded share price. You have to pretty much replicate their current share price. So our goal is to go from $25 to $425, which means we need more realistic assumptions. But that's our next step, okay? And the first screenshot along the way was our DES screenshot to tell us what price we got to get to and to tell us the share count. When you do your next homework assignment, I'm going to ask you to turn in 4 files. File number 1 is the Excel model. File number 2 and 3 and 4 are the 3 screenshots that are coming up. The first one is DES. Whatever company you value, you'll have to turn in those 3 screenshots every time. Here's part of the reason why. Whatever company I give you for next Monday, you're probably going to do the valuation on different times or days of the week. So if you don't show up in class on Wednesday to get your screenshots, you go later in the week, share price is going to change, which means your as-is model is going to be slightly different. So in order for us to know what the valuation is at the time you're doing your data pull, that's why we need the screenshot. This is the model screenshots you're tying to. Does that make sense for everybody? Okay, so screenshot number 1, right? Screenshot number 2, yes.
How, like, do we know what company we're gonna choose?
I will tell you. I'm not telling you yet, but I will tell you. Yes.
So we need these screenshots for the video, or we're saying for the next company?
Well, you might want to play along, but yeah.
But we don't need it.
You don't need it for this one.
Getting a screenshot for this.
I'm just showing you what the screenshots are. And I'm telling you what they need to be, but So like I said, if you're playing along now, you're welcome to do it, but you don't have to turn these in. But you will have to turn these screenshots for the next company, okay, for homework 9, which you do next Monday. So back to this. Screenshot number 2. We need a current whack. The whack we had in was a placeholder. I need NVIDIA's current whack. So screenshot number 2, you go to whack, you hit enter, you take a screenshot, 14.4. That's not going to help our valuation. So take a screenshot, save the screenshot, NVIDIA whack. That's screenshot number 2. But more importantly, we're going to take this crazy high whack of 14.4 and we're going to go back to our model, and under assumptions, we're going to change the whack in B4 to the current whack, 14.4. That, by the way, is going to drive our share price down to $15. We're going the wrong direction. I'm going to get to 400. Okay, but nonetheless, those are 2 of my 3 screenshots. All right, this is what's going to lead to screenshot number 3. What's really going to drive this forecast to much higher is we need more realistic ratios. We need growth rates that are not 0.25, 0.2%. All right, NVIDIA is clearly going to grow much faster than 0.2%. Okay, so we need more realistic growth rates. And their margin might improve, which means we need probably higher EBITDA margin, and we need to figure out a tax rate. Okay, so here's the other point. When you're doing your forecast, those are the 3 most important numbers to forecast. Growth rate, EBITDA margin, tax rate, because that gets you gross cash flow. Okay? And free cash flow is the most important thing to forecast. Here's the other thing that the model helps you with. Every one of these balance sheet ratios are a percentage of revenue. I did that intentionally. Here's why. When revenue grows, the balance sheet grows. Because everything's a percentage of revenue, or those operating numbers. So here's the point. If the balance sheet grows as revenue grows, you don't have to forecast gross investment. The model will create it for you, because the model will solve between this year's operating invested capital and next year's operating invested capital. The difference between the 2, the model knows has to be your gross investment. So you don't have to forecast gross investment. The model will auto forecast it for you with the following caveat. It assumes constant productivity, meaning the ratio of capital to revenue stays about the same. If for some reason a company's productivity changes, the capital to revenue ratio changes, you have to change these balance sheet ratios, right? But if you don't change the balance sheet ratios, you're assuming the invested capital to sales stays about the same, okay? That's why at the bottom of ratios, we had row 24. So right now, NVIDIA is spending 60 cents per dollar on capital to sales. So if we assume that stays about the same in the future, we don't have to change these balance sheet ratios. It will just automatically grow the balance sheet at 59 cents per dollar of revenue, and the delta between the 2 will create your gross investment. That gets you your free cash flow. Non-operating values don't matter. We're saying they're NPV 0 anyways. So we don't really have to forecast the non-operating values. That gets us enterprise value. We don't have to forecast the debt. We don't have to forecast the preferred or the minority. We subtract those. That gets us to common value. The most important value you have to forecast is your free cash flow. 3 drivers, keeping the model relatively simple. You can always forecast anything else, but these are the most important drivers. So we need more realistic growth rates, EBITDA margin, and tax rates for the next 5 years. Tax rate, where do we get it? In Bloomberg, 2 choices. 1, you can go to GUID, which is guidance, to see if the company is guiding the analysts on tax rate. Okay, and so you just look here, and you can see in their last earnings call, they gave a guidance of 13.5% to 15.5% for their tax rate going forward. Because the analysts are basically trying to do the same thing we are to figure out the tax rate. Okay, so we got 13.5 to 15.5. What number do you think we should use? Well, I'm going to split the middle. Right? I'm going to go in the middle of the range, 14.5. But you could use any number in this range to do your value, and that would be acceptable. And this would actually have to be screenshot number 4. If you did use this tax rate guidance, you'd have to do screenshot number 4. Okay? So I'm going to take screenshot number 4, save tax rate, which is NVIDIA GUID. It's actually screenshot number 3, but we're going to do one more. And I'm going to use 14.5%. Now let's say that I gave you a company that for whatever reason didn't give tax rate guidance. here's what I want you to do. So put the tax rate in. Tax rate is row 10 of ratios, and column H is the tax rate starting in next year. So I'm going to use the same tax rate for the future, so 14.5%, which will carry forward to the future. Yes?
What did you type in to get the tax rate on the Bloomberg?
GUID, guidance. Okay, that's basically in an earnings call whether the company guided in the future. Our tax rate's going to be in this range, or our tax rate should be this number. Okay, because the analysts need this number too, right? So that's one option. So I'm going to put that into ratios, H10, the 14.5%. Let's say a company didn't give guidance, right? Option B. What we would do for Nvidia or any other companies, we go to BRC. BRC are the sell-side analyst reports we have access to for a company. JP Morgan is one of the reports that we get for free, right? And it's been my experience that in every JP Morgan report, they forecast a company's tax rate. Okay, so the JP Morgan sell-side analyst is forecasting a tax rate. If the company doesn't give one, use the JP Morgan forecast. Okay, so the way you would do this, you see, look up JP Morgan right here, and just open this report as a PDF. Now, sometimes we'll get more reports in other companies, Barclays, Deutsche Bank, Wells Fargo. If you can't find in JP Morgan, you can look at another point. But basically here you can search the PDF. I'm going to search for tax rate. Hit enter, and you'll see that this is the JP Morgan tax rate forecast right here, highlighted. This is the final year. Think of that as the perpetuity period. Anybody see this number? 14.5%. JP Morgan split the difference, just like we just did. Okay? I didn't know they were going to do it, just a lucky guess. But that's the point. They're using 14.5%. So if the company didn't give a guidance, take one of the analyst reports, JP Morgan's a good one, and use their guidance for the tax rate. Yes?
What was the code that
BRC, get you to the analyst reports, and then pick JP Morgan, most recent one. Okay? Or if you don't find a JP Morgan, which you should, pick one of the others. Take a Deutsche Bank, Barclays, whatever. Just search for a tax rate. So if the company doesn't give it, the analysts still have to give one. So use what the analysts are using. Okay? Because again, we're trying to value the current share price, which means we have to have models that are realistic to what Wall Street has to be using to value that share price. Our model shouldn't be that much different from a DCF perspective. All right, so back to this. Yes?
If we use that, do you want us to take a
Source.
screenshot of that?
Source JP Morgan when you put in a report. Okay? Now, final part. What's going to be very important is our next 4 years, 5 years of growth rate and EBITDA margin. Because we're valuing the current company, and JP Morgan, Deutsche Bank, Barclays, Wells Fargo, they're all trying to do the same thing, and they're taking their forecasts, they're uploading to Bloomberg, we're going to borrow their forecasts. So screenshot number 4, in this case, EEO. This is basically the wisdom of the crowd, which is the average of all the analyst guesses financially for Nvidia. I have mine defaulted to quarterly view. Make sure you do an annual view, not a quarterly view. But these are the next 4 years of revenue. These are the next 4 years of EBITDA. Okay? So we have their forecast for revenue and EBITDA. So what we're going to do is we're going to put those forecasts for the next 5 years into our model. Okay? And so here's where we're going to do it. I'm going to go to the assumptions tab because they will change. At the bottom of the assumptions tab, starting in the first forecast year, which is B2 plus 1. And I'm going to do this for the next 5 years. So copy this over. Plus 1 equals that plus 1. Three more columns to 2028. I'm going to use the consensus revenue and the consensus EBITDA. And that will get me my EBITDA margin. Divide. Okay?
Did you
And
sell that until 2024?
And these, yes, I sell to B2 plus 1. And these cells are going to be yellow because I'm going to transform them from my screenshot. Got to type them in. Okay? So here's the point. I have my screenshot. Fourth one in this case, Nvidia -EEO. And what I need for 2024, 54621. So I'm going to start typing it. 54621. For 2025 revenue, 81257. 81257. For 2026 revenue, 97737. For 2027 revenue, 111069. And for 2028 revenue, got to go over one column here, 128,628. 128,628. So clearly not growing 0.2% a year, much faster the growth than that. All right, same thing, EBITDA in 2024. Go back a column. In 2024, EBITDA is forecasted to be 31,159. 31,159. 2025 EBITDA 50,189. These guys are like printing money. 2026 EBITDA 58,910. They're more profitable than Apple. 58,910. 2027 EBITDA 63,878. And 2028 EBITDA, go over one column, 72,458. So if I'm forecasting EBITDA margin in plain sight, it's EBITDA divided by the revenue. So B13 divided by B12. So basically a 57% EBITDA margin next year, 57.0%. And by 2028, that EBITDA margin will be 56.3. Everybody see that? So now what I need is I need my model to have those numbers. Okay? So here's the deal. On the income tab, the ratios tab, I need these EBITDA margins to basically be these EBITDA margins. Okay? So what I'm going to do is ratios H7 equals assumptions B14. Basically putting in the analyst estimates of 57%, which by the way is a big jump from 21% last year. Okay? So clearly much more profitable. And then I'm going to take H7, copy it, go to L7, and paste the next 5 years of EBITDA margins. 57 fall into 56.3. Everybody with me? Okay. I need the same thing for growth rates. So here's how we're going to do growth rates. The formula for revenue growth rate is current year minus previous year divided by previous year. Okay, that's just percentage change. So I'm going to use that formula. So starting in H3 equals left paren. Current year 2024 revenue is B12 minus previous year revenue, income, is G3, right paren divided by income G3. 102.5% growth. If those revenue assumptions come true, that's 102% growth rate that gets me there.
Can you go back to
assumptions B12 minus income G3 divided by income G3. Current year minus previous year divided by previous year. Just percentage change. That's all it is. Okay, we're going to basically recreate that formula now off the assumptions tab though. So for 2025, my growth rate equals, left paren, current year, which is C12, minus previous year, which is B12, right paren, divided by previous year, B12. They're going to grow 48.8% again next year. Okay, and I could now, since I'm working out the assumptions tab, take what I have in I3, copy it, go to L3, paste it, and those are the growth rates for the next 5 years. 102.5%, 48.8, 20.3, 13.6, 15.8. That would basically get revenue of 128,628, which means those ratios would get me in here to 128,628. Yes? Can I do what? I'm sorry? So sure. So H3? Yeah. So basically, by taking the EEO revenue forecast and EBITDA margin forecast, I have replicated for the next 5 years the revenue and EBITDA in my income tab. Okay, by changing the percentages, creates the income. So I've now matched what the forecast is, which also creates all those free cash flows and the CFI, which changes our valuation. Our valuation of Nvidia with those numbers is now much higher. I'm at 161. I'm not 15 anymore, okay? Everybody with me? Everybody get to this point? All right, here's the final thing we have to do. And this is actually very important. We've gotten the first 5 years for Nvidia pretty close to what they need to be. Now we got to get perpetuity more realistic, okay? So how do we get the perpetuity to be more realistic? First, back to ratios. I'm now talking about column M. I need these to be more realistic. I need a perpetuity tax rate. Is the perpetuity tax rate the same as the current one? I'm going to assume yes. I'm going to leave that alone at 14.5. I need a perpetuity EBITDA margin. Perpetuity EBITDA margin is, what does the EBITDA look like on M7? Okay. Now here is where we're going to do a preview of what's coming up in the next section of the book. Okay. The multiples can give you this answer. Okay. So what you're going to learn when we get to the fourth section of our class, just a preview of this, and we're going to put this on the assumptions tab, is that if we take, for these out years, the consensus EV to revenue multiple, and we divide that by the consensus EV to EBIT multiple, we get the EBIT margin in perpetuity. Okay? So for now, trust me, later you'll see the derivations. Okay? But here's the point. On the EEO screen, first screen when you come in, which is actually the one you need to take a screenshot of. Okay? I hit the bottom, but you need the top. Here is the forecasted EV to revenue multiple for Nvidia. Okay? Here is the forecast EV to EBIT multiple for Nvidia. Okay? The ones that matter are year 2 and year 3. Okay? Because companies are more based on their forward cash flows, therefore forward multiples. And starting in year 2, that's the first clean 12 months worth of forecast. Right? Because the current year has some actual and forecast mixed, and multiples tend to normalize on clean forecast years. Translation, forward year 2, forward year 3. So for Nvidia, you can count this is the current year, forward year 2, forward year 3. Okay, second, third column over. So here's their EV to revenue. They're worth 12.89 times 2025 revenue. So 12.89 and so we're going to want these 4 numbers off of the EEO. In 2026, they are worth 10.71 times enterprise value times their 2026 revenue forecast. 10.71. EV to EBIT in 2025, 21.93 times 2025 EBIT. And they're worth 18.89 times 2026 EBIT. So sitting in plain sight, if we take the enterprise value to revenue, C16 divided by C17, that gets us an EBIT margin in perpetuity of about 59%. 58.8 or 56.7. So what I'm telling you is based on those trading multiples, that's what the EBIT margin has to be in a DCF. It has to be somewhere in that range. Okay, so I'm telling you, if you go look at every one of those Wall Street spreadsheets, you're going to see a perpetuity EBIT margin around that, because that's the only way those trading multiples work. Okay, so more to come in later chapter, but that's the way it'll work. This is the math. Yes.
Are we only doing for 2025 and 2026, or you?
Right now, just these two. They're fairly close. So somewhere in this range needs to be our answer for perpetuity, because the problem is we're solving a multi-factor model, and several numbers could actually equal the same, so ranges are good enough for what we're trying to do, right? So here's the point. I need my EBIT margin in perpetuity to be somewhere between 56.7 and 58.8. That is ratios, this row. That's EBIT margin, operating income margin. You'll notice that's a white cell that we can't change. So I need M9 to be 57.7 to 58.8, whatever it was, whatever that range was. And it's not, it's 50.6. So I need it to be essentially 7 to 8 points higher. Well, I can't change that number. So how to make that number 7 to 8 points higher? I got to change my EBITDA margin higher. So I'm going to make that 7 points higher. So this is now going to be 63.3, which that's 57.6, and this says 58.8, so I'm in that range. So the point is, as good as it is now, the trading multiple suggests it's going to be even better into perpetuity. Now, to me, that's a little bit of a red flag that Nvidia might be getting a little bit overvalued, because usually in perpetuity periods, you don't see margins go up. You tend to see them regress towards the mean, but nonetheless, this is how they're being valued today. Okay, so the point is, when we make that margin, our share price has further gone up to 177, and we got to get it to 425. Okay, now I'm going to get tired and lazy, which is why you saw some scattered code when we first did this, of jumping back and forth to this slide every time I change something. So what I'm going to do is on my ratios tab, I'm going to put down here a current share price, and a model share price. So that way, every time I change a ratio, I don't have to jump over to the other tab to see how the share price changes. So for my model share price, which I now have on G26 of ratios, equals, from the valuation tab, D31. So that's the point. I can just quickly change the ratio, look at the bottom of the screen, see my new share price. Okay? For the current share price that I'm trying to get to, assumptions, next assumption down, A10, current share price. Well, that's going to change by company, so I'm going to make that yellow. But for NVIDIA, off the DES screen, we took a screenshot earlier. What was it? When we started this, share price was 425.0, can't tell. So I'll just call it 425. All right, so 425. And I'm going to go here to ratios, and for current share price equals the 425. So that's the point. I want these two numbers to be within $1 of each other when we're done. Okay, so here's the point. I put in a realistic tax rate of perpetuity. I put in a realistic margin, I think, in perpetuity. I put in growth rates, margins, and tax rates for the first 5 years. I put in a WACC. I'm pretty much left with one number in perpetuity, the G. I told you we were going to put this placeholder of G that says the company's long-term growth rate is 3%. Clearly, NVIDIA is not at that point. They're not going to be mature in 5 years, not with these numbers. So it's going to be a lot more years before they're mature. So their G is clearly higher than 3%. Okay? How much higher? We're going to solve. Assumptions. Go to our G, which is B7, and then we're going to use Tools, Goal Seek. And we're going to say, hey, Excel, tell us what the G needs to be to equal the share price. Because we've done everything else. We're just going to solve for the G. Okay? So here's the way we're going to solve for the G. We're going to set cell off our DCF valuation, the share price, so D31, to $425, the value, by changing assumptions B7, the G. And we hit OK. Excel's going to iterate, and they're going to tell me the G needs to be 10.7%. Because with a 10.7% G, that gets me to a $425 share price. I've now matched the cash flows to match NVIDIA. Save, done. When you do that, you have now almost finished, but for purposes of homework 9, finished your valuation model. We now have a reusable valuation model that we can value companies. And we've just valued NVIDIA to 425. And we now know what reasonable assumptions lead to a 425 share price. Yes?
Why are we trying to get it exactly to?
Because I call that an as-is model, and that is a requirement of this class.
Got it. And so, sorry.
So,
I'm just curious what the point
so this is a step most people skip, right? Because there's going to be 3 more models that we're going to do. The next model is going to be called the target model. Like, what do I think NVIDIA should be worth, right? And usually that's where people go. They go directly to the target. I think the company's worth this. But I'm going to teach you an intermediate step, which I think is better, because in order to get to that target, we're going to have to tweak some of these assumptions to put in more realistic assumptions. Before I tweak, I want a baseline. So the point is the as-is gives you the baseline. The as-is says, okay, for the current price, what do the cash flows have to be? What do the reasonable assumptions have to be? Now, whether I agree with those assumptions or not, these assumptions get you to that price. Then I can put in my opinion. So in this class, you will do 2. You will always do an as-is to create your baseline. From the baseline, you'll then put in your target. Okay? And those are just 2 requirements for every model that we will do going forward. And by the way, models 3 and 4, which are requirements, are the bull and the bear. Because we're dealing with the future, risk is involved. So here's my target, here's my best case scenario, here's my worst case scenario. Bull, bear. 4 models. As is, bull, bear, target. That's your valuation going forward. Yes? To get to 425, we basically solved for a G. So there were 2 ways to do this. I could just keep plugging numbers in till my share price gets to 425. That's option 1. Or I can use GoalSeek. Tools, GoalSeek. And GoalSeek basically says, set the cell I want to solve for, in this case, the share price, okay, the 425. Put the value that I'm looking for in the next one down, 425, by changing what cell, by changing assumptions B7. And so Excel will just iterate B7 until it gets to 425. And so it just made it easier than me just typing in numbers and making guesses, okay? Because it could go through 100,000 things in a millisecond. We can't. Yes?
For your ratios and the operating income, we changed it to
I changed what?
For, under ratios M9,
Yep.
what number were we changing it to? You have this 57.
So the 57.6 we can't change.
Okay,
But the reason why we can't change it is it's a white cell.
yeah.
But the point is, this cell is based on the operating income, the operating margin, the multiples that NVIDIA is trading at today in the real world off the EEO screen are telling us that that number should be in that range. And it was not. It was about 6 or 7 points lower than that when we got started. So how do I get it to that range? And the answer is I change the EBITDA margin, because I can either change depreciation or EBITDA. I changed the EBITDA because depreciation doesn't change that much over time. So I changed the EBITDA to make that number go higher. So what I did is I just raised the EBITDA margin by whatever it was, 7 points.
It was 56 before.
Yeah, so 63.3. So about 7 points to get it in the middle of that range. And now I'm in that range.
Okay, so you just added it.
I just added it to EBITDA, which is then take my EBIT margin up. Yes.
Could you click on I3, please?
I3? Okay. All right, so here's your final step, okay? Is everybody at this point? Or at least close to this point? There's a video you can watch if you're not at this point. Get to this point, okay? Because we have now just done what's called the as-is model of NVIDIA. We've created a DCF valuation, which approximates their current share price, which means these numbers have to come approximately true to value NVIDIA today, right? As I said, I'm already kind of questioning when we get to our bull bear and our target that this might be a little bit more optimistic, because usually when you get to perpetuity, numbers don't go up, they tend to go down when you get more mature. So that operating margin is a big red flag for me in perpetuity. But that being said, we're not doing those 3 models yet. The only model you're doing for homework 9 is the as is. Except you're not going to do it for NVIDIA, you're going to do it for a different company. Okay? So I'm going to give you another company right now, and that's the company that you're going to do your as is valuation on. Okay? But before I do, questions about this? Yes? You got a question?
No.
Any questions? Questions? Okay. So your as is model is going to be on Home Depot. Yes. Because I just spent a ton of money on them. I'm remodeling a bathroom, and it's friggin' expensive. Okay. So I want to see how valuable I am making Home Depot with all the money that I'm spending on them. So here's the point. We're going to value Home Depot. Okay? So here's what you're going to need to do for Monday. You're going to need to go to Bloomberg. And if you haven't already, under Home Depot, U.S. equity, you're going to go to FA, and under custom, you're going to have to create that 6-column model that we talked about in the last class video. Okay? So if you haven't done it, you need it this week. Okay? Which basically means in that data export for Home Depot, you need this file, which has these 6 columns of historical years. Remember that when you change your settings, you have to make sure number of periods you're exporting are 6. Under data, you don't export any random columns. Make sure none of those are checked. Okay? Once you've created this template, which we talked about how to do in the last video, then you will export this to Excel. Again, you'll have to do this in the lab. Once you export it to Excel, remember it's going to have the Bloomberg plugin in Excel or it's not going to work. Okay, so you're gonna have to come into the lab, and I'm gonna give you Wednesday as a Bloomberg Lab Day to be able to do this. Okay, so here's the data. But remember that this data is not data. Okay, these are not numbers. These are Bloomberg export fields. So step 2 is to select what you just exported, copy it, paste special values, replace it with numbers, because otherwise you're going to have problems when you move the data off the Bloomberg terminal. Then remember these dashes, choke Excel. We have to replace these long dashes with zeros. So copy the long dashes, find the long dash, replace with 0. You're going to replace all the long dashes with zeros. That will replace 36 of them. Save that file. Okay? To update your valuation model, you will select Home Depot. You will copy Home Depot. You will go to your NVIDIA Valuation, which you have saved. You will go to the Model Data tab. You will then select that, right-click, Paste Special Values, and you will overwrite all of the data for NVIDIA with all the data cell for cell with Home Depot. Okay? Then you will check the latest year of Home Depot, which is 2023. So then you'll go to your assumptions. Make sure the last reported year is the same. For Home Depot's 2023, we don't have to change it. That's when you start doing your screenshots. You take your WAC screenshot of Home Depot, which you turn in. You update the WAC. You take your EEO screenshot and the DES screenshot. DES, update the share count for Home Depot. Update the share price for Home Depot. That changes. Take the EEO screenshot. Update all the revenue and EBITDA. Update the 2 multiples. Then go to your ratios. Update the tax rate by either looking at the guidance or the JP Morgan report, because their tax rate's probably going to be different than NVIDIA's. Make sure that you put in a more correct EBITDA multiple for Home Depot, because it's not going to be 63%. They're not nearly as profitable as NVIDIA is. That gets you to the perpetuity EBIT margin. And then once you've done all that, solve for a G that gets the share price to match. That's your process. Okay? That's the process you got to complete for Home Depot by Monday, 10 a.m. that we'll be talking about 1 week from today. We will not have class on Wednesday, water main break or not, but this lab, the water main should be fixed, should be open. You have the rest of the week to get this data and do this individually with the model that you have done. I'll be posting this video on YouTube shortly. Okay? Good luck. Don't drown. See you guys in a few minutes.